as the recession
Basically,
bites
so the headline
than they
is
want.
fewer expected cuts in 24 as a result of today's meeting.
Less.
That's the front of the paper, is less lenient monetary policy expected as a result of the September meeting.
Less ointment for the pain when the recession really bites, if you want to think about it that way.
FOMC, they did exactly what everyone thought they would do. It's Wednesday, September 20th, 2023. This is Overtime. I'm your host, Chris Vecchio, joined by Ilya Spivak. Dylan Ratigan will be joining us in a few moments' time. I'm a little scared about that. We had some green room repartee going on here, Ilya, and it sounds like Mr. Ratigan got infected by our bullishly optimistic view of America yesterday. Certainly not the way we want to go into the trading pits, of course, but we'll take that apart in a few minutes' time. The market reaction accelerates here after Jerome Powell stopped speaking. Higher for longer is here, folks. We've been saying it. Not a surprise. Inflation is sticky. Growth is stronger than expected. Labor market is resilient. 2 rate cuts taken off the calendar for next year. Ilya, the market reaction, one thing. We'll get to that when Dylan comes here. But I suppose on a separate note, are you surprised at all by what the Fed did, or this kind of just coming right on the nose for what they should have done?
I've been beating the drum for this, and there's been no secret about it. I've been doing it on this very air. I did it on macro money over and over and over. Anytime we'd get a piece of U.S. data for quite a while. I mean, this was exactly the outcome that I was looking for. That what the markets would need here isn't for the Fed to do anything novel, but for the Fed to confirm for them that a Fed that is status quo is a risk-off kind of proposition in an environment where, of the 3 major engines of global growth, the U.S. is the resilient one, and the Fed is squarely targeting it. Whereas Europe is in trouble and China is in trouble. None of this is good for risk. It's positive for the U.S. dollar. This was precisely the response that we saw today. And by the way, the bond market did the thing that we've been talking about also. Because if you look at what's going on with the curve today, it's flatter. The front end is steeper. The back end is moving in the opposite direction. If we look at ZB, it is doing much better today than ZT. And if we look at the 5-year, 2-year spread, the 10-year, 5-year spread, it is narrowing, whereas the 2-year, 3-month spread is widening. So all of this speaks to precisely the very things that I've been a broken record on for a while. I'm pretty happy with this outcome.
As we bring Dylan Ratigan in here, let's talk about this market shakeout here on the day. S&P 500 down by 0.96% with about 22 minutes left to go in the trading day. NASDAQ off by 1.5%, 15,145. Russell down by 1.06%, 1826. And your Dow Jones off by 0.21%, 34,743. Dylan, why don't you come and join us now so I can take my airing of grievances publicly here and on air, which I'm happy to do so. You know, you don't get to, I'm in the arena trying things, as Chamath might suggest, while we wait for Dylan to join us. And there he is, the man in black, joining us from Milan. Looks like he's off on assignment from the Cosa Nostra. Apparently I was the angel on your shoulder. I guess it's appropriate that you're wearing black and I'm wearing white today, Mr. Ratigan. How are you?
So I have been for months now, unrelenting Dr. Vecchio. You know, I don't know if you know, Ilya, Chris has a CFA. If you follow him on Twitter,
I am aware, yes.
He doesn't just identify by virtue of his name, as many do, like his last name, his first name, but he wants us all to know that he has been certified and gone through the various financial bureaucracy and performance thresholds to receive meaningful qualifications, which I wrongly assigned expertise to.
Past performance is not an indication of future results, Mr. Ratigan.
That would be the first page of the CFA handbook, I believe.
After months, of being, and I've lost money many a time. Okay, yes, it's paid, but there's been many a time. I'm like, no, hold the discipline. This market must go lower, like just on price level and on rational thought. Housing, yes. Oil prices, rate pressure, it never ends. So this afternoon I sold some put spreads. It's only because I'm like, you know what? I'm too pessimistic.
My jingoistic optimism infected you yesterday.
The future is bright. EVs, payment systems, technology systems. Anyway, the point of this discussion in overtime is not to discuss my personal issues relative to my opinion. It is to discuss the fact that the Fed did exactly what it was expected to do. Mm-hmm. And the market sold off.
Yes.
And the market really should have done nothing. In other words, if we adhere to our discipline, mm-hmm. which was our suggestion that, volatility was way in coming in, the change in the market should have been plus or minus, we'll call it 0.5%. And yet, by the time the day was done, we're down 1.5%, at least on the NASDAQ. And so I'm going to go to my optimistic young friend, and I'm going to characterize Chris as the young friend, with all due respect, Ilya, because I feel like you and I have similar hair.
That we do.
Grayer than you are, but
I'll be catching up very soon, no doubt.
We're going to suggest that Chris is our young friend. How do you explain the relatively pessimistic adjustment in prices, Dr. Vecchio, CFA, in the face of extraordinarily expected activity?
Good question. I don't necessarily have a good answer.
Well, then I'll ask Ilya.
Truthfully.
Well,
I would say it's a question for the three of us, which is we got what we wanted. Sure. We talked about the hippopotamus dancing on the pinhead. Yes. I would argue that the hippopotamus did a good job, danced on the pinhead, didn't do anything that was expected, like actually nailed the landing.
Yes.
And the market should have gone out unchanged or plus or minus 0.5 point, which I'll call the same as unchanged. But we got an actual move lower.
Yes.
Why?
I can explain. As a matter of fact, and I'll pat myself on the back just a tiny bit. The title for macro money yesterday was "Stocks will fall and the dollar will rise even if the Fed changes nothing." And I'm paraphrasing here. I was a little bit more even-handed in the actual titling of a thing that happens in the future and that nobody knows about. But the upshot was exactly that, because for me, this wasn't about the Fed changing anything. This was about the market lens changing. For the past, let's go all the way back to when this started, June of 2021, since then, since the June 2021 FOMC, the Fed basically has said, look, we know we said that this inflation thing was going to be a transitory kind of thing. Mostly, we were wrong. We're going to have a meaningful tightening cycle because it's not mostly the thing that we thought. It's mostly this other thing. And so we're going to have to do something about it. Ever since then, the object of speculation in markets has been, when will they go? How hard will they go? How high will they take us? How quickly will we get there? And it's been a very sort of narrow kind of speculation. Is it going to be 25 or 50 or 75? When? How long? Etc. My argument since the start of this year, and it hasn't been very successful in the first half, and it's started to come around now, was that it's time to stop thinking so narrowly because we've had a lot of tightening. Now the conversation will become and is becoming, What are the consequences of what's been done? Less so what's the Fed going to narrowly do at the next meeting and the one after that, but what will all this cost?
But again, and I'm just going to go back to the discussion with Tom on truth. The rational discussion of the headwinds, negative consequences of the Fed, consequences of the mortgage rates in the residential real estate, consequences of work from home in the commercial residential market, consequences of higher oil prices on manufacturing margins or margins, on and on and on. And the argument from the market, not from me, I've been against the market to my sometimes benefit and detriment, depending on the day, has been that the prevailing optimism of Dr. Vecchio, can I call you a doctor with a CFA? I'm not sure how that works, but I'm going to try it.
Assuredly not.
But it sounds good.
Of CFA Vecchio.
Not even allowed to call myself that, but we'll go on.
That the prevailing optimism, whether it's again regarding the things that, payments, transportation, technology, AI, streaming. It's fairly broad, actually.
Yes.
I'll take it from payments through AI to transport and streaming. So content, infrastructure, all those things. That the overwhelming optimism for those things is exactly that, overwhelming. That for whatever the things that Dylan or Ilya or any other sort of naysayer, including Tom Sosnoff, by the way, might say that the negativity that's associated with that analysis is weak in comparison to the extraordinary objective force of the future.
I think there's a fundamental difference to that narrative now, because if you were to have that narrative, and I think that was exactly the narrative, and by the way, I think it remains the narrative when risk is on. So if you had to pick sort of sectoral allocation when risk more broadly is on, that would be the story. And I think it makes sense that would be the story. But risk is not on. And the difference now, if we were to look at it at the beginning of this year, we were not looking at a global recession risk because Europe was hampered, but not like this. And there was lots of optimism that China would reopen to great fanfare and come back and be the buoyant world's second largest economy that we knew before the pandemic. And all of that optimism is now gone. And rightfully so, because it didn't make sense then, and it doesn't make sense now. So the resiliency to all of these headwinds that could have been had were growth better on a broader scale, because growth can generally paper over everything. That's not there anymore. That's gone. And what the Fed is telling us here is they won't be the same.
You're saying that after one afternoon and one Fed? I mean, come
on. No, not at all. I'm saying, looking at the PMI data over the past 6 to 8 months, we can see global growth coming undone. The question was, when would the markets begin to care?
And you're saying,
in my mind, it's belated. I think they've been caring probably since the start of the second half of this year, incrementally over time.
So again, are you a seller tomorrow morning?
Of course. I've been seller of what? So my way of expressing this has been to be long the US dollar, because my sense was that the Fed wouldn't back down and that would maintain yield differentials in the dollar's favor. But more importantly, that when markets get scared and they liquidate into dollars first and foremost. That's the cash of choice, because it is the most liquid and therefore the least volatile. So I've been long dollars, and I've been long them for on and off a few months at this point. So,
but you're not willing to be like me, explicitly short equities.
I've not done that yet. I do have some inverse.
What is your calculation to be long dollar relative to short equity?
So my sense is that I'm going to be long dollar for a while yet here. I think there's no indication that the move is ending at this point, and I think the risk aversion is just getting started. I think I would be much more given to be outright short equities, although I do have, in fairness, I do have some inverse S&P ETFs, but nothing of size. I would
and not
think,
of short duration, not of that's
more like a hedge. Nothing aggressive.
Yeah,
I would think I would get more outright short equities and start to lean in if we were to, let's say, close under the September low on S&P, which is about what, 44.30. 44.35. If we got a close under that, I mean, we're looking at the NASDAQ here dipping into the bottom of its range. I would want the price signal. I would want that range to crack. I would want the S&P range to crack. And that would be a sort of price action confirmation to say, okay, here we go, lean in.
If I may, to help recover my temporarily besmirched reputation here.
you do have a CFA, so we must listen.
That's true. That is actually in the handbook.
Second page of the handbook.
I will point out that I've maintained, you can check the tapes, that there really hasn't been a directional signal in this market. And I'm really more of a directional momentum-based trader.
Yeah.
Even if you're trying to trade a range-bound market, there hasn't been much vol to pick up. No premium to pick up by selling vol right now. So I found it to be a pretty unappetizing environment on the whole. I think what changed today, though, is that we do see that 2 rate cuts are taken off the table. The whole fantasy of this market the last few months has been that the Fed is going to be able to raise rates perhaps a little bit more, but they'll be able to stamp out inflation for good. And as a result, everything will be copacetic by the first half of next year. Then we can resume getting back to normal pre-pandemic type of monetary policy by the turning point of 2024, right? We get to the June meeting, they have a new SEP, they lay out their substantiation for cutting rates, and they do so. And they cut 3-4 times in the second half of next year because, well, they're not going to engineer a recession for the sake of giving us a recession. What they want to do is make sure that inflation's dead. But there have been near-term factors like energy prices, like food prices, that have pushed up inflation in the short term, albeit at the headline, not in the core reading. And there are still deflationary pressures coming down the pipeline, like that we've seen in the housing market. Their owner's equivalent rent metric that they use is very, very lagged. If you look to the apartment.com or Redfin or Realtor measurements of rent growth or house prices, they have come in substantially over the past few months, and they are likely to signal that deflationary pressures will continue. So that is the problem for today. 2 rate cuts that we thought could materialize next year are no longer going to be there. The Fed is telling us that they don't see inflation getting back down towards 2%, not in 2024, not in 2025, but in fact, if we go to the summary of economic projections and we look to their PCE expectation, well, maybe 2025, 2026, more likely when we get closer to it. And the market doesn't want to hear that because the market wants to see lower interest rates. The market wants to see the Fed funds rate back at 2.5% or 3% sooner rather than later. And today is a wake-up call that that's just not going to happen. Does this mean that a hard landing is coming in? No. But a government shutdown and a UAW strike that's prolonged dramatically increases the odds that you have a weaker pace of growth in the fourth quarter. We've started to see some of the student loan debt data come in. The Treasury's coffers are quickly being replenished back to pre-pandemic levels now that those payments have started to roll back in. And there is a real risk for economic growth to dramatically cool off as we head into the end of the year. And Ilya, I shared a chart with you earlier today. Auto loan delinquencies are up, credit card delinquencies are up. Now interest rates are going to be staying higher for longer, which means most of the country, which doesn't have the benefit of being in a situation where they have substantial savings built up, has to rely on their plastic to get by through their consumption trends. And that means there may be trade-offs down the line, or consumption has to be curtailed completely in order to service that debt. And so this is a wake-up call. We are going to be going into a window of pain where the bill does come due, where the effects of that tightening over the next few months ultimately are borne
But
out.
hang on a second. How can we get exactly what we expected yesterday from a market that had extremely limited volatility, and all of a sudden Chris Vecchio was saying the bill is coming due?
I would say we didn't get exactly what we expected.
Yeah, by the end of the day, the market's moves were actually outside of the expected range when you look to the options market.
I know.
Okay, fair enough. Yes.
Yeah.
Fair enough. Yes. This, by the way, goes to my endless qualm with this idea that if volatility is low, that means nothing will happen. No, it means the market doesn't think anything will happen, and then something might. So you can't take the market's relative calm to mean it necessarily will endure under all circumstances. But
hold on, just for all the kids playing along at home, what is different this afternoon? In other words, Chris is saying we didn't get what we expected. You're saying we didn't get what we expected.
Yes.
So what exactly is the difference?
I'm happy to
what we expected.
Well, sure.
I think we got most of what we expected, right? But for the cuts coming off the table next year, what really is a surprise?
That's the part that matters. So if we look at the priced in outlook, and we said this on the show yesterday, the priced in outlook for Fed funds end of 2024 before this meeting was 4.6. The Fed had in their June SEP 4.6. So my sense was if you do anything north of 4.8, which would be obviously the Fed sets policy in ranges. So 4.5 to 4.75, the middle is about 4.6. If you got anything north of 4.75, so 4.8 or higher, that would be hawkish. We got 5.1. So the markets are going to get less help next year as the recession bites
so the headline
than they want.
Fewer expected cuts in 24 as a result of today's meeting. That's the front of the paper is less lenient monetary policy expected as a result of the September.
Yes. Less ointment for the pain when the recession really bites, if you want to think about it that way.
But what has changed in these markets? I mean, the Russell's starting to look a little bit more sick, but when I look at the S&P 500 or the NASDAQ, from where I stand, okay, we've lost the uptrend from the September 2022, March 23, August 23 swing lows, and that opens up a return back to those August lows here in the S&P, about 43.97 3/4. To say that we're going to go beyond there yet, I don't know if we have the technical evidence to make that kind of, presumption, but momentum is squarely becoming negative, right? We're back in oversold territory in stochastics. MACD's beginning to keel over. Never quite got that ascension through the signal line there, what it's worth during the recovery. The NASDAQ, though, is still, broadly speaking, within the, now it's moving into the lower half more, but it's still in its range. I don't really get bared up about this market until we're below 14,750 here in the NASDAQ. And if we do...
Educate me. So what is it about these levels, both of you have mentioned, like, until I get to this price point or until I get to that price point or whatever your level may be, that you believe that if you see some particular level, that it has more meaning than the level you currently see?
I mean, from my point of view,
technical analysis interpretation, is that some sort of insight to sentiment or what does that mean to you?
Sure. I mean, technical analysis is effectively a study of, human psychology and consensus on prices at any given point in time. And so if we were to move below the August lows here, given the fact that, where we're trading today, 15,152 in the NQZ3, it's a level we traded at the end of August. It's a level we were at the end of June. It's a level that we were at in the beginning of June. So the market really hasn't gone anywhere for several months. If we're just going to be, objective about it.
Yeah. Price level adjusted in the first half. And I was like, you have to sell this.
Yeah.
And then it's just kind of been holding, and maybe it's about to break lower now. And I guess your argument would be that it's going to break lower because there's been adjustment and expected easing for 2024 as a result of today's discussion. That would, right or wrong, that's the sort of...
Yeah. I mean, that's the way I read this. And as far as technical levels, I'm kind of a simpleton when it comes to technical analysis. I basically say, okay, what's a trend higher? It's a sequence of higher highs and higher lows. What's a trend lower? It's a sequence of lower highs and lower lows. If the market, the price, the purest kind of reflection of market mood, the price itself, if it's in a range where you can very clearly see here's the top of the range, here's the bottom of the range, and the range follows a series of higher highs and higher lows, then that tells me an up move has lost conviction and is waiting to see which way it wants to go. Does it want to keep going higher, or does it want to now reverse lower? If it takes out the bottom of that range and closes under it, then that tells me it's made up its mind. Maybe not, but it's a good bet that it's made up its mind.
It's just, at least it's an explanation of your interpretation of levels, which was my question.
Yes. So
right, but
that's also the way I think about it.
There's also a functional form to this, and this is where I get to put on the CFA charter holder hat. Can't even call myself a CFA. That's against the handbook, literally.
Third page.
I will point out that when you think about the NASDAQ, right, along the spectrum of assets, tech stocks, particularly newer tech stocks, companies that have thinner margins, that don't have large cash balances on their, balance sheets, they are exposed to credit markets, to debt, in order to get the funding that they need. And so they effectively are longer duration. When I mean long duration, if for every dollar invested today, how long will it take for me to get paid back? And so now that interest rates are going up, what's the relationship between duration and interest rates? Well, long duration assets tend to suffer more than short duration assets when interest rates go up. So we just heard from the Fed today, interest rates may not be going up, but for those of you at home that were pricing in lower rates at this point in time in the future, this is now your new interest rate that you have to work with in your model, which means the future value of all future cash flows just took a big hit. Yeah. And so it actually makes sense when you look at the Fed's projections. Okay, I now need to price in a 5.1% rate next year as opposed to 4.6. What does that do to my multiples? What's the value of the equity that I'm holding here? What are the chances of default going up for this particular batch of companies? And all those things now change in the equation. And so, yes, this is not great for stocks. There's going to be likely a period of digestion and readjustment here moving forward. Does that mean that this market's doing anything uncharacteristic, though, during such an event? I would argue no. There's a few things that pop out of my mind. We're in the Rosh Hashanah Yom Kippur window of the year, which has produced negative returns for stocks going back 50 years. August and September are two of the worst months of the year, going back to time immemorial. You can choose a time span, 5, 10, 15, 20, 50. It will be a bad period of time for stocks. The year before a presidential election, August, September, October into the first week of November produces, historically speaking, a sideways move in markets. So the fact that markets are moving sideways and lower with sustained interest rates being elevated, it kind of fits with the picture. Ilya, you can testify to this in case Dylan takes me to court for his trades today. I've been saying for a long time, I think we're going to...
I would never. I'm a man of personal responsibility. Although
I appreciate that.
Blame in the same name. I assign blame in the name of entertainment.
Of course.
In the name of a litigation.
Of course, I appreciate that. But in any event, I mean, Ilya, how long have I been saying I think that we're going to see a lot of chop for a while here in these markets? Yeah. And then it's only going to be once we get into, closer to the winter months that we actually see the market rally pick back up steam. So
I will qualify a little, but yes, you have been saying that. I've been on the bearish side of that call, saying I think that there's actually more pain,
absolutely,
and more mayhem. But I think we've agreed that there will be pain and mayhem, just on the question of the extent, the timing, and the duration is where we find difference.
I think it's a sine wave. I think the market's going to go up and down and slinky around here for the next few months. And we just had a move higher. There's your up. There's your down. Here's a little bit more up. We get below 14,750. I see the technical case for this topping out and a much more significant pullback ahead.
Yeah.
Our job, I think a lot of traders confuse this because there is, you turn on financial entertainment, radio, television, any information source. And how do you make a name for yourself in the business? You make a prediction, and the prediction comes true. and you saw into your crystal ball something else that no one else saw. So you must be a genius. You must have an edge. That's sexy, so to speak, right? It's egotistical. As traders, our job is not to make predictions. Our job is to read the tea leaves. You know, when the market does this, what typically happens next? Play the odds, right? Our job isn't to make a name for ourselves. It's to make money. So we shouldn't really care about what happens in the future so long as that we are positioned for it in the proper manner. And so right now, you know, is the market going to move sideways? Me saying that, is that a prediction? Yeah. Am I bound to it? No. Strong convictions held loosely. If information arises that changes my mind on a longer term outlook, I am happy to get on board with that. And that's been the case in point for what's happened with crude oil this year, from at least my standing. For the better part of the first half of the year, I was saying sideways, iron condors, sell strangles, right? Range bound market, range bound market, range bound market. Then we get to July and I go, something feels different here. Time to change your mind, time to abandon the range. Here's why: the information presented to us has evolved, and so too should our outlook. The tool in which that we take out of our trading toolkit now needs to change, because if we keep trying to jam this square peg into a round hole, it's not going to work. And so as far as I still see it, period of adjustment coming up, higher rates for longer. We knew it was coming. The Fed's been telling this to us ad nauseum for several months. If you listen to anything that the Fed has said, unfortunately or fortunately, I guess I have the unique privilege of being the person here who reads through every single Fed speech in between meetings. And if you want to check out what Fed speakers were saying, head on over to the tastylive Traders blog and look up the note that's there about staying higher for longer. Our editorial team, I think, found Rastafari, because he's getting higher for longer as the image.
That was, I think, possibly the best image for any article this year.
But Chris, did you change your opinion today?
My opinion today is that we're probably going to see a little bit more downside in the near term, given what the Fed has told us. But does it change the possibility that this market is going to stay range bound longer term? No, I don't think so. Now, if we see the 2-year yield jump up to 5.5%, that's probably going to deal with a lot. That's going to be painful, and that could change my mind. Did we make that advance, though? 2-year yields did jump higher today, but the market ended up giving some of it back. The high here for the session was 5.149%. We technically move higher to 5.135% by the end of the day. But the 2-year yield has a very strong correlation with what's going on with the Fed funds rate. I would argue that the Fed is not going to move in November either. We say that the Fed is data dependent right now. What data is coming out between now and November 1st? We have a non-farm payrolls report, which may not be released because of a government shutdown. We have a CPI report that may not be released because of a government shutdown. And those are the only two things that are really important to the Fed moving forward. So will one CPI report, one non-farm payrolls report, which they might not even see, will that cause them to move? No. I think if they are going to move, they're going to move in December. And now we're talking about nearly 3 months until we get to that December Fed meeting. A lot can change during that time. So is another Fed rate hike fait accompli? Absolutely not. I have no idea of knowing which way it's going to happen. Market pricing suggests that it's not going to at this point in time.
That's right.
But if Ilya is correct, the Fed is wrong about only cutting rates twice next year. They'll be cutting a lot more.
How so? Yeah. You're saying that the Fed will cut more aggressively?
Absolutely. The Fed caves in. The Fed is like a paper tiger when it comes to holding their ground, when it comes to keeping rates elevated for a long time. You have to fight. The Fed needs to be beaten over the head with information to raise rates. And the second that a light breeze moves through the room, it could be because someone walks in the door behind them, not because there's an actual storm outside, they will find an excuse to cut rates. And I think they will. The second that they see inflation's down, I mean, Powell spoke to this during his press conference today. People are spending money like it's going out of business, right? Like it's burning a hole in their pocket right now, even when you adjust for inflation in many regards, when you look at the totality of data this year. But you see sentiment surveys and they're down in the dirt because people hate inflation. People don't like the fact that when they go to the grocery store, prices are 17% higher than they were at the start of 2021. It bothers them more than anything else.
By the way, when he said people hate inflation, that was the most emotion in the entire press conference.
I would agree.
But the point is that the market doesn't care.
For now.
And this is sort of the crux of my argument.
I mean, we're talking about a 1% move here today in the S&P, less than 1.5% of the NASDAQ, 1% of the Russell, 0.25% of the Dow. I have seen a lot worse price action on much better days. This is not something I'm going to lose sleep over
This is
tonight.
not some sort of washout sentiment change. This is a slight change to a slight reduction in the probability of rate cuts next year.
Absolutely.
Yeah, I mean, I don't think this is a washout yet. I mean, it may be or it may not be. We'll see. If I thought it was a washout, I'd be an outright seller of equities now. I'm not. I think if we consider what's going on here and what the market is afraid of, yeah, I think the Fed might have to do more cuts than they're currently going to allow for. And it's because inflation expectations for right now have been going higher. The market was very clearly signaling to the Fed since the beginning of September, if you stop now, if you truly, in all earnestness, stop, you're going to lose grip on this. Because the 2-year break even has gone north of 2% in September. The 1-year USD inflation swap has gone much closer to 3. It's just sub 3 now, 2.7. So all of that is saying the swaps market, the bond market is telling the Fed, you can't stop right now. At the very least, you can't say that you've stopped. You can pause, but the messaging has to be you're prepared to go when and if. I don't think the Fed is a paper tiger. I think the market gets this wrong at its detriment all the time. 2014 was a great example where they thought there would be no rate hike cycle. They second guessed it and second guessed it and second guessed it. And then the dollar rallied for like a year and a half in a straight line because they had to reposition. It was the same thing this time.
But are you saying the market is not an efficient pricer of future outcomes?
I'm saying the market changes its pricing of future outcomes when new information comes in, as it should. So I think the market has a best guess on a given day. I don't think that guess is necessarily reflective of what's going to happen tomorrow or the day after, because new information will come in and the markets will adjust. The market is a discounter. It's not a crystal ball.
Well, you want some bearishness for you, Dylan. You want to have an excuse to go back to selling call spreads in tech stocks. This perhaps is the most convincing chart that I've seen today, one of the two. This is the BOTS ETF, the Global Funds Robotic and AI ETF. It made that double top move down to the 2510 area back at the end of August before bouncing. And today it puts in an outside engulfing bar, a new high relative to yesterday and closed below yesterday's low, which is a signal of a bearish continuation from a technical perspective. It does so, and it does so in a manner that to me looks like it's on a path towards a much weaker level. The 100% extension of the recent move from the highs that we see in July, low in August, back to the September first high, carries us down to $21.88, which, if you look back at our charts right around here, where do we have some highs coming in November and December last year, right around 21.5, $22. That being one for the AI narrative and the other KRE for the regional banks, which showing more signs of creaking and cracking today. You know, we talk about narratives in this market. The banking crisis is over. AI is here. It's going to save the world. These are two places that make me feel uncomfortable. And quite frankly, being ticker agnostic, as one should be when they look at charts, they're not pointing to an immediate rebound in price right now. So if the banks are going down and AI-related stocks are going down, it's going to be, at least in the very near term, I would say likely that it's difficult waters for the Russell and the NASDAQ. Does that mean we take out 14,750? I have no idea yet. But does it increase the odds that we return to a level like 14,750 in the NASDAQ? Sure.
I mean, it sounds to me like I should be a buyer based on my experience with you yesterday.
I never told you to buy anything yesterday.
I'm not saying that you did.
Dylan,
you're offering a very pessimistic outlook.
I'm prone to, as someone said last week, I'm prone to perhaps exaggeration.
Well, no. Sosnoff said it on the Truth or Skepticism today, which is sort of the uniform truth, regardless of any personal feelings or admonishments. No one knows.
Of course.
No one. And so
right.
it is the trade mechanics, i.e. probabilities, i.e. sizing, i.e. liquidity. That is it's only if you're in liquid names with reasonable size and reasonable pot odds that you stand a chance.
Yeah.
And
I think that's right.
For he, like me, who believes they know something or have a point of view, that doom awaits.
It's best not to get too wrapped up in one thing. We don't marry any of our positions, Dylan. We only speed date around here.
That's
right.
But even that is purely based on mechanics. The interesting thing is both of you for sure have, I mean, Ilya was already kind of there, but Chris was our resident optimist, our resident.
I'm optimistic long-term. What can I say?
I mean,
as am I.
But your view of the short-term dynamics was diminished by virtue of the perceived reduction in rate cuts for 2020.
Yes, because I think so. I sort of look at markets as the mission, not necessarily of trying to figure out what will happen, but how the markets would read a range of scenarios and what they would mean, and then which scenario is most likely. I don't think this is really a game about, is AI really going to be the promised land or isn't it? Is there going to be a global recession or won't there be? I think it's more about what does the market interpret these things to be and how do they react to incremental changes in the narrative. So this from the Fed was an incremental risk-off change in the narrative. There will be a higher cost to borrowing money, which means there will be a higher hurdle rate to all new things than there was expected to be before, to the tune of about 50 basis points. That matters.
Maybe.
Well, in the market's current conception.
Between now and November, blah, blah, blah.
Of course, but that doesn't matter. Because nobody knows what that data is going to say. But in the market's current conception, that's what it is.
Yeah, but,
sorry, go ahead, Chris. Sorry.
Early in the year, the Fed was pricing in recession. They were pricing in inflation coming down quicker. They were pricing in a labor market that was going to weaken dramatically. And so the baseline of expectations when you enter 2023 relative to what transpired in the first half of the year, that delta is pretty wide. Things are much better than the Fed envisioned. They're much better than the average market observer envisioned.
The NASDAQ's up 40%. We have adjusted prices accordingly, sir.
And what happens now going into the second half of the year? Everyone and their mother who was bearish at the start of the year starts abandoning all of their bearish hopes, right? Mike Wilson, the chief equity strategist over at Morgan Stanley, famously tosses in the towel on his bear call for the S&P 500 in the last week of July, which is right when the NASDAQ peaks. We are down.
Not about where I started buying the bulk of my dollar position that I have right now. Not because of what Mike Wilson said, but that there seemed to be a sort of sea change happening after we got through the banking crisis and the last version of the debt ceiling idiocy. Of course, we're back there now. We weren't supposed to be.
That's a self-produced, preposterous.
It's so stupid on so many levels. It's just. So I don't even want to get on this soapbox.
You know the famous or infamous rant when I was on MSNBC in 2011?
Of course.
Yes. Entirely triggered by my frustration at the time with the seriousness with which the MSNBC booking and guest and sort of DC apparatus wanted to debate the debt ceiling.
Yeah.
Which, I mean, it's like if I said, listen, if Chris talks to me again, I'm going to chop off my finger. Well, let's say I don't want Chris to talk to me anymore, which I love talking to Chris, so this is a bad example. But let's just presume Chris had driven me crazy with his CFA and his optimism, and I can't take it anymore. And I'm like, you know what? If Chris says another word to me, I'm going to chop off my finger. And then Chris says something, and then I decide I'm going to chop off my finger. There literally is nothing more stupid. Like the entire debt ceiling construct is purely a construct to chop off other people's fingers, actually. I wish it was their finger. They're saying, if Chris talks to me again, I'm going to chop off Ilya's finger.
Yeah.
Right. They're saying if I don't get what I want, I'm going to shut down government services for people that it matters to in the VA, in the healthcare system, with veterans, with firemen, with teachers, with people that are the least desirable or least worthy victims of political vitriol. So it's actually worse than me chopping off my own finger if Chris talks to me. I say, if Chris talks to me again, I'm going to chop off all the fingers of the teachers.
Yeah, no, it makes so little sense.
Which the biggest issue for me, because analyzing this is, a doomed and idiotic proposition, other than the fact that the market's relative stability in the face of objectively absurd U.S. government is remarkable to me.
I actually am very heartened by the fact that whereas the first episode of this earlier in the year got some headlines and at least kept Fed expectations for aggressive cuts this year at least stable until they decided that it was lunacy and they rebuilt the outlook back. The whole notion that this is somehow a forcing function to be more prudent on spending, as ludicrous as that is, maybe this is probably wishful thinking, but maybe the market is finally starting to come around to the idea that it's no such thing, that it's complete and utter lunacy to think that the U.S. can default in the current environment, that this is even a thing you could price in. I was saying this back earlier in the year. There is no asset price for any asset that reflects a U.S. default. That price does not exist, because if the dollar is the unit of commercial exchange globally, and U.S. government debt is the risk-free asset baked into every single market internationally, everywhere, then if the U.S. defaults, there is no market as we know it. It's a hard reset of market structure writ large. So the whole thing is nonsensical on every level.
Let's dispel with the notion that politicians don't know what they're doing. They know exactly what they're doing, as Marco Rubio might have once said several times ad nauseum during a debate. But that's neither here nor there. Dylan, I know it's getting late for you, and we're holding you past your typical time here. You can ride this out to the end. We only have a few minutes left, or you can get in the final word now. Your choice.
Keep me. I mean, what are we doing here?
Well, then let's keep going. Ilya, I guess the point is that, going back to the whole Mike Wilson conversation.
Yeah.
The first half of the year is defined by the fact that things are much better than anticipated. The game is, yes, and markets are never about reality. It's about perception. It's always about perception.
And forward-looking perception.
And what happened now? You look at the Fed forecasts, and growth is stronger, labor markets are stronger, inflation gets bumped up in PCE, but it comes down to the core. This is the Fed saying, we think a soft landing's coming, whereas all their other projections up to this point in time were saying, no, we're going to drive this economy into the ditch. And now they're telling us that, no, we're actually going to avoid the ditch. That is perhaps the single most alarming thing.
Yes.
Right? The wall of worry apparently no longer exists. We've torn it down. We've climbed it. We scaled it through the summer months. We're now here. Everyone agrees a soft landing's coming. It's official. Right as we have strikes and government shutdown and student debt loan repayments coming and potential escalation in the war between Ukraine and Russia, or rather Russia's invasion of Ukraine, right? We're seeing that perhaps it's expanding to the African theater now with Ukrainian strikes on Wagner Group positions on the continent. There's been talks about North Korea and maybe even China offering not just weapons, but even ground support to Russia. And so does the market care about any of these things yet? No. So the fact now is do you want to say price to perfection? It certainly seems like that things are priced pretty optimistically here. And the Fed is now telling us, by the way, they're so good that we're not going to need to cut rates as much as we thought in 2024. Yet they've set the stage by staying higher for longer for precipitating an economic environment whereby recession becomes that much more likely, in turn creating the need for more rate cuts next year. And so look, the market's going through a period of readjustment.
Where you're outsmarting yourself, right? Because now
perhaps,
well,
but I just see this as now a period where the market has to say, okay, hold on, rates aren't going to be getting cut next year. This means I have to take down my growth expectation. Because if you're raising the cost of money, as Ilya says, you're going to constrain credit, which means you're going to reduce lending in the economy. Growth is likely to be weaker. In fact, I don't know how they substantiate saying we're going to keep rates higher next year than we thought, while also bumping up growth expectations by a nearly commensurate amount. That doesn't make sense.
What's the most rate sensitive asset class that exists right now that's liquid, that's at a sort of first tier liquid asset class? Is it technology growth companies?
Tech stocks, various things in the debt space. You have junk bonds, corporate bonds.
Yeah,
cryptocurrency.
I would say things in the Russell and in the NASDAQ as opposed to things in the Dow, to kind of
in terms of relative rate sensitivity.
In terms of relative rate sensitivity.
A weaker Russell, a weaker NASDAQ on a relative basis.
Yes. So that would be
assuming we believe, to Chris's point, that rates will be not reduced as fast next year based on today's decision, which the expectation that rates won't be reduced, in fact, creates a probability that they will.
Well, so I think there's this perpetual difference in basically sequencing, because the markets are much more reactive and much more readily there to change their perception than is the Fed. The Fed operates on a much slower reaction function, and the markets are constantly ascribing to the Fed their own lens, saying, well, now that this has happened, the Fed's going to do this. Now that this has happened, the Fed's going to do that. And the Fed is sitting there and going, yeah, I'll see you in 6 to 9 months when we get enough data to even have a conversation about changing our bias. So
I would argue the Fed knows nothing. The Fed knows nothing more than to follow the behavior of the market. That the Fed is a lagging indicator, not a leading indicator. That 12 of the smartest people on earth, with all the best data in the world, in the most beautiful Corinthian leather boardroom in the world, have no chance against a multi-hundred billion trillion dollar bond market that is, to the millisecond, repricing risk, to your point.
I would say that that's probably not how I would characterize it, if only because the Fed has much more power than any of those people in the markets to shape their outcomes. And so it's not so much that the Fed is reactive to the markets. It's that the Fed is on a different time scale. And so the markets and the Fed are basically seeing the same trajectory, but the markets are oscillating around that trajectory much more wildly in terms of their perception. And so
this has been a problem for decades, right? Markets are always chasing next quarter's financial results.
Yes.
Right. Board of directors are always trying to figure out how they can get their earnings a little bit better so they can get their stock compensation packages, fulfilled, so that they can take their parachute and go home. Whether or not the business stays alive for the next 10 or 15 years isn't their concern. Their concern is the next earnings report, right? And the Fed doesn't think that way. The Fed thinks, well, look at their projections here. 2023 is a little weird because this particular SEP, we have 2 Fed meetings left for the end of the year. So, but they're talking about 2026 in their projections and longer than that.
Yeah.
The market, and first off, the Fed is probably wrong. They're always wrong about their long-term stuff.
And they admit as much.
Yeah, they're throwing darts at a dartboard. But Ilya, I'll give you the final thought here because we have to wind down for someone else has to come on the air, which is you.
Yes, indeed. So just one last thing on this. If the market were leading the Fed, would we have a stock sell-off today? Maybe not. Because if the market were leading the Fed, why wouldn't they have anticipated this? Why did people feel like they needed to reposition today? It's not because they knew that it was coming. It's not because they knew that this exact thing was going to happen. It's because they clearly felt like they were positioned wrong and they had to change their portfolios to some extent. Not a dramatic extent, but to some extent.
They could just as easily be up 1% tomorrow.
Guys, if the market's up tomorrow, if the market's back up tomorrow, we wipe out all of today's losses.
Yeah.
All of today's losses.
Yeah.
No one should be surprised.
No.
This market may not be going anywhere fast.
They absolutely could. Because they could take 24 hours to think about it and change their mind.
Very well said. To watch more of Ilya Spivak, Macro Money's coming up next every Monday through Thursday here on Tasty Live, 5:30 Eastern, 4:30 Central Time. Of course, it's preceded by Overtime, 4:30 Eastern, 3:30 Central. He's also on First Call Sunday evenings, 5:55 Eastern, 4:55 Central. You can catch Dylan Ratigan here with us on Overtime, 4:30 Eastern, 3:30 Central, Monday, Tuesday, Wednesday, Thursday, or some mishmash of those days. Whenever he's free, we are welcome to have him. Beyond that, he's also on Truth or Skepticism, 2 p.m. Eastern, 1 Central Time with Tom Sosnoff. That's on Wednesdays. You can find me here on Tasty Live Monday through Friday, Futures Power Hour, 1 p.m. Eastern, 12 Central Time. Let Me Explain Tuesday mornings, 9:40 a.m. Eastern, 8:40 a.m. Central Time. But with that, Overtime is now out of time. We're taking a quick 23-hour break, folks. We'll be back tomorrow for the final episode this week. Until then, good luck trading. Up next, Macro Money with the man himself, Ilya Spivak.
See you there, folks.
Ciao.